Welcome to the ZionsBank Economic Update. My name is Joseph Mayans, and joining me is Robert Spendlove to discuss the current economic conditions. Robert, we seem to have had a lot of good economic data that's come out recently, specifically kind of starting with the recent jobs report we just had. Can you kind of walk us through what we saw there?
Yeah, so we just got the data from May recently from the Bureau of Labor Statistics, and the jobs report was very strong. We were expecting job growth nationwide of around 190,000, came in at 223,000 people. That's near the top of the range of economists' expectations, so very strong. The other thing was our unemployment rate had been hovering right around 4%, 3.9% for the past several months, dropped down to 3.8%. That is very significant. It's as low as it's been in about 20 years, and it matches rates that we haven't seen since the late 1960s. So very low unemployment. Now the struggle and the thing that we're still trying to figure out is wage growth. Came in at 2.7% on an annual basis, which is better than it was a few years ago. But before the Great Recession, wage growth was at 3.5%. So it's still not where it needs to be and where it should be given a very tight labor market. And one of the reasons for that is even with very high employment growth, very low unemployment, our labor force participation rate actually dropped in May, which is pretty surprising. So what it's showing is that the economy is not doing a good enough job of bringing people off the sidelines and back into the labor market.
So it seems like we're saying the economy is doing pretty well, not perfect, but good. And that's kind of what was behind the Fed's recent decision to raise the federal funds rate another 1/4 of a point. When they made that announcement, they also put out projections. Was there anything that really stuck out to you, or maybe some reasoning behind why they raised rates?
Yeah, so the Fed has now raised rates 7 times in the past several years, dropped rates down to essentially zero for a significant period of time following the Great Recession. But now, as the economy improves, the Fed is raising rates. They want to get back up to what they would call a normal range of around 3% on the federal funds rate, which is the short-term rate that the Fed controls. What was really interesting, though, so the Fed raised Fed funds rate by 1/4 of a point, up to a range between 1.75 and 2%. But what kind of surprised people was the Fed's forward-looking statement. For the past several months, they've been saying that they would raise rates 3 times in 2018. They've now said that they're going to raise them 4 times. And so why would they go from 3 times to 4 times? They're starting to see signs that the economy is overheating, that there's this fear that as the economy continues to improve, that we're going to see wage growth accelerating, but accelerating very quickly. And if wage growth starts to accelerate very quickly, we could also see inflation accelerating very quickly. And part of the Fed's dual mandate, their dual mandate is full employment and inflation at 2%. And we just got new CPI numbers. The Consumer Price Index came in, the headline number was 2.8%. And the core CPI, which strips out food and energy, came in at 2.2%. And so if we start to see an escalation of this inflation, of it going up very quickly, and more signs of the economy overheating, the Fed knows that they're going to have to get more aggressive. So they're in a really tough position. They're kind of walking a tightrope, where if they raise rates too quickly, they could stall out the economy. But if they don't raise rates quickly enough, the economy could overheat. And so we're kind of seeing this dance that the Fed is going through right now.
Yeah, that's very interesting. And it sounds like from the projections that they're being fairly optimistic of how they see the economy progressing. What do you see in the future that maybe could stall that or maybe be a drag on the economy?
Well, there's the structural issues that we just talked about, and everyone kind of knows about that. But there's becoming more and more talk of what about the black swan that no one can forecast, but is just kind of waiting there. Now remember, we're 108 months into our of consecutive months of job growth, longest ever. We're 9 years into this economic expansion, And it's the second longest overall expansion in our nation's history. But with that, we know that a recession is on the way. We just don't know when it'll happen or what will set it off. And so everyone's kind of watching to see what will be that event that sets it off. One of those black swans could be a potential trade war. And we're hearing more and more talk from the president, from other countries about tariffs on imported goods and retaliatory tariffs. And we're not just talking about small countries. We're talking about Canada and Mexico and Great Britain and Germany and France. And if we start to see these kind of retaliations, and how does that drive you into a recession? Well, what is a tariff? It's essentially saying that people will have to pay more for a product than they were paying in the past. That turns into inflation, and that could set off this overheating of the economy, and the Fed would have to get more aggressive in raising rates.
Yeah, it's going to be very interesting to see how those developments take place and whether the Fed's able to stick to their now new projected rate path.
Yeah, definitely.
So thank you, Robert. Thank you for joining us for this economic update. For more information and analysis, please visit ZionsBank.com/economy.